Good evening and welcome to iBanker U News Tonight, coming at you very early on this Friday, February 6, 2026. Special recognition goes to Connie, who helped us out at Walmart when we were there a little earlier in the evening. 80 years old, still working, helped us find doilies for a get-together that we're hosting. And of course, she knew exactly where they were. And honestly, when's the last time you went to a party that had doilies? We can't remember when it was for us either. Connie knew exactly where they were. She walked us halfway across that gigantic store. And most sweet, pleasant, warm, endearing person I've met in some time. Reminds us of our grandma. Past generations were really raised right, but that's another topic for another video. Thank you again, Connie. Tonight, however, we're going to discuss why does 80-year-old sweet Connie need to work at Walmart at all? 80 are supposed to be the golden years. Kicking back, 4 p.m., senior special dinners, endless hours of gin rummy with friends and grandchildren on the weekends. So much of our faith in humanity was restored by Connie's genuine warmth and helpfulness that we cannot help but wonder, what kind of society breaks its social contract with the generation that built this nation? How did we get here? You feel it. I feel it. Nobody in power talks about it. They keep telling us that everything is fine. Actually, not just fine, strong, resilient, surprisingly robust. The stock market is at or near all-time highs. The S&P 500 trading at roughly 21 to 22 times forward earnings, well above the long-term average of about 16 times. Mega-cap multiples stretched like a yoga instructor in a hot room. Financial television smiling ear to ear. And yet, people feel broke. Not emotionally broke, not TikTok broke, functionally broke. So let's start with the obvious question, the one that nobody on television wants to sit with for more than a couple of seconds. If the economy is doing so well, then why does it feel like it isn't? Why is consumer confidence rolling over while equity indices keep levitating? Why are credit card balances at record highs, over $1.1 trillion, while talking heads keep telling you the consumer is strong? Why are delinquencies rising, especially among subprime auto loans, during what we're told is an economic expansion? Why is that? Here's what nobody is talking about. The market is not the economy, and the economy is not the household balance sheet. Those three things used to move together. They don't anymore. And that separation, that fracture, is the story. Let's talk numbers, real ones. Real disposable personal income after inflation is barely positive. Wage growth looks like it's decent in nominal terms. Sure, 4 or 5% sounds nice until you net it against sticky services inflation, housing costs, insurance premiums, healthcare, property taxes. Then suddenly that real wage growth starts looking a lot more like a rounding error. Meanwhile, the cost of money has exploded. The average credit card APR is now north of 20%. 20%! Auto loans that used to be 3 or 4% have more than doubled. They're now 7, 8, 9%. Mortgage rates doubled, and no, prices didn't fall enough to offset. So you ask yourself, what happens when asset prices inflate faster than incomes while the cost of leverage spikes? You get the illusion of prosperity, not the reality of it. This is the part people in power refuse to tell you. Asset inflation is being mistaken for economic health. When the Fed injects liquidity, when balance sheets expand, when financial conditions ease, that money does not flow evenly through society. It never has. It goes first and hardest into financial assets, stocks, bonds, real estate, private equity, anything that already has a ticker or a term sheet. That's not a conspiracy. That's what's called the cantillion effect. And it's Econ 101 for anyone who's ever cracked a macro textbook. But turn on the news and you'll hear stocks up, economy strong, nothing to see here. Strong for whom? Let's be precise. The top 10% of households own roughly 90% of equities. The bottom 50%, almost nothing. So when markets rip higher on multiples expansion rather than earnings growth, which by the way is exactly what's been happening, that wealth effect everyone loves to talk about, it's highly concentrated. Translation, your rent doesn't care that Nvidia went up 40%. And here's the quiet part. Corporate earnings growth has been fine, not spectacular. Margins are under pressure from labor, financing costs, and slowing top-line growth. So how are stocks still flying? Multiple expansion, buybacks, passive flows, and the assumption, always the assumption, that liquidity will return. Because markets no longer trade on cash flows alone, they trade on central bank reaction functions. Ask yourself this. Why does bad economic news sometimes make stocks go up? Why is that? Because markets are no longer pricing growth, they're pricing policy response. Weak data, rate cuts. Stress, liquidity. Slowdown, stimulus. The market has been trained, conditioned to believe that pain will be socialized and upside will remain private. But households don't get that deal. Households face refinancing cliffs. Households face rolling debt at higher rates. Households face real expenses today, not discounted future earning streams. And here's the part that should make you uncomfortable. The consumer hasn't been strong. The consumer has been liquidating savings. Excess savings from pandemic, gone. Savings rate back near multi-decade lows. Buy now, pay later, replacing emergency funds. Credit substituting for income. That's not strength. That's duration risk. And yet, every month, we get the same script. Soft landing, resilient consumer, Goldilocks. Goldilocks apparently now includes 20% APRs and negative real purchasing power. So why does the narrative persist? Well, that's because optimism is structural. Financial media is not designed to tell you when to get cautious. It's designed to keep capital engaged. Advertising dollars come from asset managers, banks, brokerages, ETF sponsors, institutions that require AUM stability. Bearish narratives cause outflows. Outflows shrink fees. Shrinking fees don't buy ad slots. Funny how that works. This is why risk is always framed as contained, why bubbles are always pockets of excess, why valuation concerns are outdated models. And look, this isn't about doom. This is about honesty. The truth is more nuanced and more uncomfortable. We are running a two-tier K-shaped economy. One tier trades duration, multiples, and liquidity expectations. The other trades hours worked, debt service ratios, and grocery bills. One is floating on discounted cash flows. The other is drowning in monthly payments. And when policymakers say the economy, they usually mean the first one. So when you feel like the headlines don't match your life, when markets celebrate while your expenses compound, you're not crazy. You're just not in the asset owning class. And here's the final question nobody wants to answer. How long can that gap persist before something breaks? Because eventually consumption slows, eventually defaults rise, eventually earnings feel it, and eventually liquidity does not fix solvency. Markets can ignore households for a while. They can't ignore them forever. So the next time you hear everything's fine, ask yourself, fine for who? Measured how? And funded by what? Funny how those questions never make it into the segment. And Connie, I know this generation's a disappointment, but please know there are still some people left on this planet that actually care and appreciate you and everything you and your generation did to get us here, even if our leaders have failed us. Thank you for watching all the way to the end. Join us tonight when we go into Wall Street Knows What's Coming, part 3 and 4 after that. And history's lessons we forgot, but may relearn really soon. Please subscribe, comment, and share if we have earned it. to the sworn enemy of lying, hypocrisy, Wall Street tyranny, and anything else directing you towards the wrong side of the trade. In the meantime, as always, build that stack.